Good morning. Welcome to the deep dive with Keeping Current Matters. It is Monday, May 6th, and we are live. We're going to be talking about all the things mortgage rates today. My name is Kate Rezebeck, and I'm thrilled to be here with you. You know, there's been so much talk about what's happening with mortgage rates, especially coming out of the Fed meeting last week, seeing the employment data come out on Friday. There's just so much packed in here to talk about that I can't wait to dive deep into all of it with you. So we are going to go ahead and jump right in today. As always, thank you, KCM members, for continuing to come back week after week. If you're new to KCM, thank you for joining us. This is a great way to start off your week with the most important topic in the housing market. And I want you to stick around to the finish line today because I have some really cool resources I'm going to share with you. We're going to be talking about the best way to get this message on mortgage rates out there. We have some KCM resources to point you to. And we're going to be talking about an exclusive deep dive series that we're kicking off over the next few weeks. So hang on to the finish line. We'll get there, but we've got a lot to unpack until then, particularly what's the latest on mortgage rates. You know, I have a bunch of visuals to share with you today because we think a picture says 1,000 words and it gives you a little bit of perspective. So I want you to take these visuals, share them out in your sphere, talk to your clients about them, and of course, add your perspective because that's the educator that matters. When you step up and add your value with the data, the insights, and your perspective, that is a combination that just can't be beat. So we are going to get started this morning, and I want to begin with this quote from Nicole at Zillow. It says, "The biggest thing when we're looking at mortgage rates right now is volatility." We have been talking about that word for quite some time. We are in a volatile market, especially when it comes to mortgage rates. That's everything we're going to unpack right now. And the bottom line is that it is going to take a little bit longer for mortgage rates to come down. But we're going to follow the economic drivers. We're going to follow all the indicators to continue to bring that information to you so you can have the latest data, the latest insights to be able to explain this volatility to your clients. Because when your clients understand why this is happening, it alleviates that fear that can start to build up for sure. So let's take a quick look at this mortgage rate volatility. This is the daily mortgage rate going back to October of 2023. We remember when mortgage rates kind of peaked around that 8%. We saw them coming down at the beginning of the year as we saw all these economic indicators, inflation and other things starting to show some relief for mortgage rates. We got into that downward trending environment, and now we're starting to see mortgage rates tick back up a little bit. But we even saw a little relief on Friday. So much has happened in this time. And I want to make sure you have the data and the insights and the education to really understand it so you can explain it for your clients. Because there's a lot of things that go into how mortgage rates are determined. And I think this quote from Odetta Cushy really says it well. She says, "Every month brings a new set of inflation and labor data that can influence the direction of mortgage rates. Ongoing inflation deceleration, a slowing economy, and even geopolitical uncertainty can contribute to lower mortgage rates. On the other hand, data that signals upside risk to inflation may result in higher rates." So there's so many different factors that come into this. You know, a lot of people think the Federal Reserve sets mortgage rates. It's not that simple. And those are some of the things I want to share with you because there's really three things that you can kind of be looking at right now to understand what are those leading indicators on where mortgage rates go. The first thing you want to be looking at, of course, is inflation. We talk about this all the time. You know, we say inflation is the enemy of long-term interest rates. When inflation is high, mortgage rates tend to be high. There's a lot in there to be following when it comes to inflation data. The Fed's decision. We're going to break down a lot of what happened last week in the Fed meeting, what they've been saying over the past couple of months, what the indicators are going forward. You know, as the Federal Reserve makes moves on the federal funds rate, that's a reflection of what's happening in the broader economy, and mortgage rates will respond. And then geopolitical events. You know, there's a lot happening in the world around us that impact the economy, that move these things in the financial markets. And so it's really important to be looking at those things: inflation, the Fed, and geopolitical events. And I think that NerdWallet also says it really well. This quote says, "Mortgage rates are influenced by many elements, including the inflation rate, the pace of job creation, and whether the economy is growing or shrinking. the Federal Reserve's monetary policy is a factor too, and it's set by the Federal Open Market Committee. So we've heard a lot of talk about that Federal Reserve decision last week. We saw the jobs report come out on Friday. We're going to dig into all of that and talk about how that impacts mortgage rates today. So before we jump into the Fed decision, let's remember mortgage rates are indirectly influenced by the Federal Reserve's monetary policy. When the central bank raises the federal funds target rate, as it did throughout 2022 and 2023, that has a knock-on effect by causing short-term interest rates to go up. So they don't actually set mortgage rates, but as we mentioned, their actions indicate what's happening in the broader economy, and mortgage rates respond. That's kind of that knock-on effect you see called out in this quote right here. And sometimes these changes are priced in as the markets anticipate what the Federal Reserve is going to decide. Sometimes they're a reaction as mortgage rates respond after the Fed meeting. We see all of that in motion. So when these factors kind of come together, that's where we see mortgage rates start to move. So what did the Fed do last week? Well, the latest Fed decision on May 1st was that the committee decided to maintain the target range for the federal fund rate at 5.25% to 5.5%. So basically what they've been doing over the past couple of years, we've heard us talk about this for a while, is the Federal Reserve has been raising the federal funds rate. They've been trying to slow the economy. They saw some of that happen, starting to really reflect in the inflation data last year. So they started to say, okay, we're going to pause our rate hikes for the federal funds rate. So, raising the federal funds rate essentially makes it more expensive to borrow money. They decided to pause. We saw that reflected in the broader economy. We saw it reflected in how mortgage rates responded towards the end of last year as they started to kind of tick down a little bit. And what they've seen over the past couple of months as more inflation data has come out in particular was, hey, we need a little more time. There was an anticipation that the Federal Reserve may be starting to cut the federal funds rate in the first half of this year. And they're saying, you know what? We need to see some more definitive trends in a slowing of the economy for that to happen. So while we thought, and a lot of experts thought that, maybe the federal funds rate would be cut earlier in this year, it's going to take a little bit more time. And that's that knock-on effect as they look at the economic indicators that will drive their decision. So what are they looking at going forward? This is the big question. So the Federal Reserve said the committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So all the things we just laid out, as these are the factors that impact mortgage rates, the Federal Reserve is going to continue to follow, and they need a little bit more time to see the trends that they're looking for, the slowing economic trends that they want to see before they cut the federal funds rate. So what happened on Friday? They came out of the Federal Reserve meeting on Wednesday, and then on Friday, the labor data was released, and I want to show you what came out of that. So CNBC said that the U.S. economy added fewer jobs than expected in April, while the unemployment rate rose, lifting hopes that the Federal Reserve will be able to cut interest rates in the coming months. So good news. Non-farm payrolls increased by 175,000 on the month, below the 240,000 estimate from the Dow Jones Consensus. The unemployment rate ticked higher to 3.9% against expectations. It would hold steady at 3.8%. So more jobs added to the economy, but not as many as expected. So that is a cooling sign, strong labor market, but a cooling sign that the Federal Reserve will be looking for. Same thing with unemployment rate. Thought it would come in at 3.8%, came in at 3.9%, so a little bit higher, another strong but cooling factor. And it's these cooling factors that they're really trying to look for to see when will we be able to cut the federal funds rate. And I think some context is really helpful on this too. This is a graph that we put together from the Bureau of Labor Statistics, and it's the unemployment rate. And it really has changed very little. You can see over on the right that it ticked up ever so slightly in this last reading, but certainly not even near the long-term average, certainly not back to where those red bars were when we saw such high unemployment back in the pandemic. but the unemployment rate ticked up just enough to say, hey, maybe there's a cooling factor on the horizon. Every time we look at unemployment data, it's always fascinating to dig in and see, where did we see some of the trends? What industries or sectors might have been impacted? Education and health services were some of the places where we saw job growth. Retail and transportation, not unexpected as we come into these summer months. And then the one that caught my eye was construction and manufacturing. So adding jobs to the construction and manufacturing market is really good news for the housing market too, as we start to talk about what's ahead for new construction, for kind of starting to overcome some of these deficits that we're seeing in inventory. So really interesting leading indicators. We certainly see that labor market has cooled, but it is still strong, and that is certainly a factor to look at. Danielle Hale from Realtor.com says, today's cooler labor market data is a sign that mortgage rate relief could be on the horizon, but that will be dependent on inflation. We're going to talk about inflation in just a moment. We may see an unseasonably active summer and fall if inflation improves and mortgage rates drop. So as we see some of these cooling factors in the labor market, we continue to watch where inflation is, and that coming down. Those are the things that will be drivers to cut the federal funds rate, and then ultimately some of those knock-on effects that you see that start to bring mortgage rates down. So it's all these factors that we got to watch, and that's what KCM does, is we watch these for you so you can come to one place to really understand, what does it all mean when they all come together. Now let's talk about inflation for a moment, because this is something you've heard us really hit on a lot over the past couple of years. Inflation today continues to exceed the Federal Reserve's target rate. You can see that target rate across the bottom at 2%. We're certainly not where we were when it was nearly 9% back in July of 22, but over the past couple of years, raising the federal funds rate has helped to bring, that slowing of the economy. Inflation is coming down. But what happened over the past couple of readings? You can see those two orange bars on the right. Inflation came in higher than expected. So not significantly higher, but not the cooling effect or the deceleration even that the Federal Reserve was looking for in February and March as they kind of went into the latest Federal Reserve meeting. So what we're seeing is that as inflation is high, mortgage rates tend to stay high, and they're looking for a little bit more time to bring inflation down and to see those readings come in a little bit lower. And I think that's really kind of what we want to keep our eye on as we talk about all these different factors to watch. Inflation is definitely one of them. And I think this quote right here says it very well. The FOMC did not change the federal funds target at its May meeting, as incoming data regarding the strength of the economy and stubbornly high inflation have resulted in a shift in the timing of a first rate cut. We expect mortgage rates to drop later this year, but not as far or as fast as we previously had predicted. So that is the general consensus of, the reactions of coming out of inflation data, the Federal Reserve meeting, all of those things that we've been watching, is that mortgage rates are still expected to come down, but not as far or as fast as we had previously expected. And that was right from the Mortgage Bankers Association, and continuing to watch that inflation data to see what's happening and where that leads us. And I think if you take a look at these federal funds rate increases that we've seen over the past 2 years, you can see that they were much more aggressive going back to, May, June, July of 2022. They started to ease off as we saw progress and inflation starting to come down. And then you can see those rate pauses over on the right side of the screen where the Federal Reserve is saying, okay, we're close, but we're not there yet. We need a little bit more time. And that's exactly what they said in their latest meeting. We need a little bit more time. And what I want to do now is show you another really couple of powerful visuals, because the why on why they need a little bit more time is really, really impactful. So here's a quote from Jerome Powell, chairman of the Federal Reserve, last month. And he said, reducing policy restraint too soon or too much could result in a reversal of progress we have seen in inflation, and ultimately require even tighter policy to get inflation back to 2%. So what does that mean? We can't move too quickly. We have to continue to watch the data. And this next visual is the one that's going to really explain why. So let's sit on this one for a moment. This is the CPI going back to 1970. So one of the measures of inflation that the Federal Reserve looks at. And what you can see is back in the 1970s, the early 70s, inflation was rising. And that's what you see in that left oval over there. Inflation was kind of ticking up. And so what the Federal Reserve had to do was raise the federal funds rate to bring inflation down. So you can see that happened, that first peak and valley. And then what happened back then was that they decided to cut the federal funds rate, but they did it just a little too early. So this is one of the big reasons why the Federal Reserve today is saying we need more time, because when they cut too early, inflation spiked back up and they had to start that work all over again. We certainly don't want to be in that position today. So fast forward over to the right side of the screen and you can see that other oval, that smaller one, that's where we're working at today. Is inflation was rising. They started to increase the federal funds rate. Inflation started to come down. And as the last couple of readings came in just a touch higher than they expected, they said, hold on, we don't want to repeat history. We don't want this to happen again. So they're going to buy a little bit more time to make sure that they're really seeing those consistent trends of a slowing in the economy. And that's a big, big reason why they're taking this, take their time approach right now. And if you look at what Jerome Powell said coming out of last week's meeting, he said, my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. So that is watching all of these economic drivers. They're watching inflation, they're watching employment, all the different things that impact their decision. And they're going to take a little bit more time to make sure they do it right. And so everybody's wondering, when does the next federal funds rate cut come? Well, we can watch some really interesting market data to get perspective on, what's trending in the financial markets. And this is from the CME group, and it says that there's a 69.6% chance that the Fed cuts at the September meeting. Now, at the beginning of the year, there was hope that maybe that cut would come earlier in the year, and that would start to have that knock-on effect on mortgage rates coming down, maybe even toward the end of the spring market into the summer. I think it is much more likely, as we watch these trends, that it's going to be later in the year. How many cuts, of course, still to be determined, but roughly a 70% chance, as this Market Watch tool says, that the Fed will cut at its September meeting. But let's be really honest, this data is changing constantly. And that's why I want to show you this next slide, because it's really interesting on how these economic factors can change the outlook so quickly. The odds of a September cut a little over a month ago, if you look over to the left side of the screen, were almost 90%. Everybody was saying, yeah, September, we're going to be cutting rates by then. Well, coming into the end of April, as we're continuing to watch inflation data in particular, percentage started to tick down. Going into the Federal Reserve meeting last week on April 30th, the odds people were saying and experts were saying was roughly about 45%. Coming out of the meeting on May 1st, the next day, odds started to tick back up. And then we saw employment data be released, strong but cooling labor market toward the end of the week on the 3rd, and then even today, odds of a September rate cut ticking back up. So this is a great leading indicator on perspective of what might be coming as we look later into the year. Now, there's always the question too of, well, could the Federal Reserve actually hike rates again? Could they tighten monetary policy further? And Jerome Powell said directly, I think it's unlikely that the next policy rate move will be a hike. So that's really good news as we think about what does all this mean for mortgage rates, as we watch geopolitical events, as we watch inflation, as we watch job trends, all of those different things. What does this mean for rates, mortgage rates in particular, going forward? Well, we have the latest projections from some of the key experts that we follow. And really what they're saying, if you average out Fannie Mae, MBA, and NAR, the latest projections that we have from the end of April is that mortgage rates should continue to trend down this year. If you look at, that green bar that just came up around the screen, Q4 of this year, Q1, Q2 of next year, below that 6.5% mark and maybe down even next year into the high sixes. Now, again, we saw that quote earlier. It's not as fast or as far as we originally predicted, but a lot of the experts are saying that's because we're still continuing to watch the economic data, watch what the Fed is doing, watch what the experts are saying, where all these factors come together. So if we can keep our eyes on what's happening right now, what does this mean going forward? And as agents, be able to bring this perspective as the educator of here's what the latest data says and how it's changing. That's the best way to educate clients right now, to prove value, to be the trusted advisor, working with a trusted lender right now in a volatile market, mission critical to have those partners to help navigate through this, to talk through what's happening and why, and what are all these factors. But the good news is we're still in a downward trending environment. And if you look at what MBA says, they are projecting mortgage rates to continue to come down this year and next as we watch these economic factors impact where they are going. So definitely in that downward trending environment, I think as we look at what all the experts are saying, we have to remember mortgage rates are the toughest thing to project in the housing market. Look at all these factors we talked about today. Everything is kind of coming together in this puzzle, and it's moving constantly as the economic data changes. So yes, a downward trending environment. Experts are saying they will continue to come down, but they are the hardest thing to project. And the best thing to do is bring the most current data to your clients and help explain the why. Because what we also know is that more people are starting to think that mortgage rates might not come down. They're seeing all this talk, all this chatter, all the headlines about inflation and everything that's happening. And the percent of respondents who think mortgage rates will go down in the next 12 months actually went down in March, as a lot of this was circulating around the news. So January, February, 35% of consumers felt like, yeah, I see the light at the end of the tunnel. They were starting to see mortgage rates tick down, and they were saying, yep, I believe that this is going to happen. Well, that percentage dropped in March. And that's where the confusion and the fear and the I'm just going to press pause on my plans starts to really hit your clients. So being able to understand that consumer perspective and communicate that out is mission critical, because that's how we remove the fear. That's why we help people understand why things are happening. Because as Bright MLS says, expect rates to come down in the second half of 2024, but remain above 6% this year. Even a modest drop in rates will bring both more buyers and more sellers back into the market. And that's really important to talk about, because it's going to change the mindset of consumers as they start to see rates come down. And that's going to change what's happening in the housing market. And I love this graph that we use that shows demand based on rate environment. And this is a really strong analysis of what's happening in the 30-year fixed mortgage rate. You can see that white line that's coming across your screen going all the way back to the beginning of the year. That's the daily mortgage rate. And you can see how demand changes based on where rates are. Bottom line, when rates come down, demand increases. We saw that in the beginning of February, as you can see kind of over on the left side of the screen. When rates came down, we definitely saw more demand in the market. We saw purchase applications go up. As rates start to tick back up, we're not at 8% anymore, that's for sure, but they're higher than they were a couple months ago. Demand starts to weaken. And so really understanding how people act in these environments and being able to communicate with your clients on what does this mean is mission critical. Because, you can have conversations all day about, hey, clients, mortgage rates are projected to come down. Here's what all the data says and what the experts are saying. And if someone turns to you and says, that's great, I'll just wait, then you want to be able to ask a really important question. And that important question is, what do you think everyone else is going to do? You ask that question and people start to realize, well, as rates come down, all this pent-up demand that we might be feeling right now, this competition for limited inventory, people are going to jump back in the market. It's not going to be the floodgates of what we had when there were 3% mortgage rates, but we're certainly going to see more people jump into those good and strong buying demands as rates come into below 6.5 and even below 6% is going to bring a lot of buyers back to the market. So if someone's waiting for mortgage rates to come down, being able to talk to them about what does that mean? It means more competition among other buyers, more multiple offer scenarios, harder to find a home potentially, and prices continuing to rise as buyer demand goes up and inventory is still constrained. Sure, we'll see more houses coming to the market at that point too, but it doesn't make it easier to find one at that point. So we want to be able to help people who are ready, willing, and able today to buy realize here's what the data says and what that means for the market if they really want to make a powerful and informed decision going forward. We never want to push anybody into buying a home by any means, but we certainly want to give them the perspective to be able to make an informed decision, not just a wait and see decision. And that's where your value as the educator is absolutely priceless, because we know there's going to be a mindset shift as rates come down back into the sixes, back into the low sixes, and certainly below 6%. Even into next year. So a lot to talk about, a lot to consider as we have these conversations with our clients. And as you always hear us say, most agents know that this is happening. It is very clear what's happening in the market. The good agents really understand it, and the great agents can explain it. And if you can take this information, share the visuals, talk to your clients, and get this message out there, that is going to be the game changer for you and for your business. So really making sure that you are able to explain what's happening. Now, I want to give you or point you to a couple of resources that I think are going to be super, super helpful. We are in a downward trending environment. We've got to make sure we get this information out to our clients. And if you are a KCM member, one thing that you are getting in your inbox every day that I want you to pay attention to is your KCM must share content. We deliver at least 3 pieces of content every day to KCM members. It's something to read, something to share, and something to record. Now, we know reading a blog is a great way to get a short snippet summary of exactly what's happening and be able to be that educator and your client for your clients. When someone asks you questions, or if you're in conversation, if you've read the KCM daily blog, you have access to all the answers you're going to need, all the background data, insights, and information. So reading the daily blog every day, mission critical. Sharing it out on social, we give you a social graphic every day with a pre-made caption. You can edit the caption if you want. You can adjust the branding colors, all that stuff, but we give you something to share on your Instagram stories and feeds. We have both formats, really, really good stuff to kind of start to spark that conversation in your sphere. And then of course, we also have a real talk script. So you can record a video. Everybody knows you got to be on video. That is the best way to get your message out there. Little 15 to 30-second videos on what's happening with rates, how you are the expert. You know, that's what you want to be talking about. We make it so easy to do that without any technology experience required. So if you're a KCM member, you're getting these in your inbox, links to these that you can go check out every day. They're on a specific topic. This one happens to be the one we did on mortgage rates just last week, coming out of the Fed meeting. Really, really want to encourage you to go look at those. If you're not a KCM member, try kcm.com. Our team can pop that into the chat link so you can see that and go check it out and explore a little bit more. But every day we will have these messages for you. Because what do we have to do? We have to be the educator. And at the end of the day, if we're getting these messages out, read, share, and record, we can absolutely do that. Because in this market, we have to control what we can control, not what we can't. And the one thing that you can do in any housing market, no matter what is happening, rates are going up, they're going down, you name it, you can be the educator. And that is something that you can control to prove your value, to show what's happening, to really be the expert. So when your clients are ready to buy or sell, you're there for them and they know to turn to you. So I promised you at the end, we went through a ton of information here. It was a lot. If you want to go back and rewatch the recording, I encourage you to do that. But let me tell you what's coming up next week, because we are starting an exclusive KCM 3-part series deep dive on what every buyer needs to know right now. You're thinking about, how do I prove my value? How do I be the expert? How do I be the educator? And how do I get these conversations going so my sphere knows I'm the expert to turn to? We're going to walk through a 3-part series starting next week on May 13th. First one is what every buyer needs to know about pricing. And then we're going to give you 2 more sessions. May 20th, we're going to skip Memorial Day on the 27th, and we're going to finish up the first Monday in June on this 3-part exclusive KCM series. I am super excited for it. I hope that you are too. Please come back and watch that with us, because that's going to be the visuals, the conversations, the market insights, everything you need to truly be the expert. So thank you so much for being here with us today. I can't wait to see you back here next week. It is my pleasure, and I hope you have a great week.